spot rate, and certain theories. If you remember, we talked about three theories: liquidity premium theory, expectancy theory, and market segmentation theory. And within that, we talked about concept like term to maturity and others. And after that, once we covered interest rate part, we we have seen application of interest rate, where we have seen we talked about when we talk about time value of money. There we have seen how interest rate or your required rate of return or cost of capital. So those are terms generally used. So we have seen how interest rate, what are the various application in interest rate. Then we have also seen valuation. So in valuation, the role of interest rate is very important, because unless you know some kind of benchmark, your expectation, you cannot determine any kind of asset value, because you are going to discount it for appropriate rate. So in this, we talked about stocks or equity. We talked about bond or debt instrument, and we also talked about preference share. And within bond, if you remember, within bond we had a discussion on several concepts. We talked about structure of bond. Structure means we have seen example of one bond of I think State Bank of India, where rating and how it looks like when it is being traded, what kind of details you will find, like par value or face value, coupon rate, then maturity, then rating, issuers details. So all these structure related to agreement or particular bond we have seen. And then we have also looked at various proxies for measuring. And then we are talking about proxy, we are talking about yield to maturity. Remember, yield to call, then duration of bond. And then we have also slightly discussed the relationship between duration and interest rate sensitivity. So duration and interest rate sensitivity. And we have also discussed how price, especially bond price, and with interest rate, these two keep on changing, and we get a non-linear relationship. And then why you need a better measure than duration. So if you remember, we talked about convexity. Of course, we have not gone into detail, but we know the basis why convexity adjustment or adjustment for non-linear relationship between change in the bond price and interest rate is important. So we discussed that convexity is one of the major reasons whenever interest rate movement is large. So more or less, if you see, so from interest rate up to its application, and application in terms of valuing three type of assets, basically your stock, your bond, and preference share, we have discussed. And we have also seen some concept when your particular equity will be overvalue or undervalue and related concept we have seen. So now what we will do based on our these discussion, we will do some problem today and then few concept related to market efficiency we will discuss. So but before going into market efficiency or new concept, I want you to try this problem. Everyone, you try this problem. Already we have done similar kind of problem yesterday, but I expect that we should try so that your concept in valuation is going to be clear. So every student, you can look at this problem and try to solve. And once at least 4 or 5 students are ready with solution, I'll discuss how you can approach to this kind of problem. And if you need any additional information, you can ask me, I'll be available. And so that this problem, you should be able to do it. Already all the discussion that we had till yesterday, that makes you, makes you comfortable in solving this type of problem. Yeah, so you can take 10 minutes to solve this problem, and once you are done, we will discuss how you should approach to this type of problem. And in case any clarity you need, additional clarity about this question, you can ask. It should not take more than 10 minutes. So I think after 10 minutes we will discuss.
Hello, sir.
Yeah.
Sir, I'm not able to see the question.
Yes,
it is still on under overvalued stock slide.
A problem you can't see?
No, sir.
Yes, sir. It is still on the under overvalued slide.
How it is? Because in my system, right now, can you see problem?
No, sir. It is still on that slide. Under overvalued one.
Okay, let me think.
Sir, also there was a large lag while you are annotating the slide. The text came around like 3-4 minutes later.
So what I'm doing, I'm again sharing. So I'm stopping my sharing. Now, what slide you are able to see? Can you see my slide?
Yes, sir. Undervalued and overvalued.
Okay, fine. So now can you see that problem?
No, sir.
It may be, can you see now?
No, sir.
Still no, sir.
There may be, issue with internet, but it should not be the case. Let me reshare. Now what can you see? Now can you see my screen?
Not yet, sir. It will take some time.
Okay, you let me know. I think because of internet speed, this problem is arising.
Yes, sir.
Now you can see?
Not yet, sir.
Is it visible now?
No, sir.
No, sir.
Not yet. It's
Okay,
still
so what
at
I'll do,
blank.
I'll copy it. Blank.
Yes, sir.
Yes,
Now,
sir.
now it is there.
Now we are able to see, sir.
Okay. Let me now share it. Can you see?
No, sir, it
Now
will
I'm
take
trying to
time
use
again.
my. Okay, so meanwhile I'll arrange LAN because Wi-Fi may be slower. Now can you all see my screen?
Yes, sir.
Yes,
Okay, now you can try. So any detail if you find it's not there, you can ask to me. So this is multi-period growth rate type of problem. So yesterday we have discussed, so same kind of approach will be required. And once you are done, you can raise your hand. We will discuss after that. I hope everyone is able to do this problem. So you need to just use a time value of money concept for multi-stage dividend payment. Yeah, Anuj? Yeah.
Yes, sir.
Okay. Okay. So let's get, 2, 3 more students response and then we'll discuss.
Okay, sir.
Yeah, other students? Yeah, Ronit. Ronit, are you able to do? Ronit Kumar.
Yes, sir. I'm doing it.
Okay. Aditya.
Yes, sir, I'm doing it.
Okay. So far, two students are able to do this problem. Srinivas? Srinivasa? Ganesh Kulkarni?
Yes, sir, I am trying.
Okay. So if you're not able to get any point which is mentioned in this problem, you can tell me. I will explain so that you should be able to do this problem. So I'm waiting for at least one more student's response and then we'll discuss. Yeah, at least now we have at least three students who are able to solve this problem. Yeah, Karthik. Karthik,
Yes.
can you hear me?
Yes, sir.
Yeah, so what approach have you used? How you have solved this problem?
Sir, I tried to find the dividend payment for all the years from for the first year
Okay.
and till the sixth year we'll get at the rate of the growth would be at 8%, and after that with that amount I multiplied by 1.06, that would be the payment for the 7, 8, 10 till 10th year, and after that uh, it would be constantly multiplied by 1.03, and everything have to be reduced to today's value.
Okay, so what number you are getting?
I'm getting 111.45, sir. 111.
111 point. This number, right? Yeah, Anuj and Vaibhav. So are you also getting same number?
Yes, sir. My answer is also same. It is 111.4487.
Okay, okay. I think yeah, it's if you round it for up to two digits, it will come. Yeah, Vaibhav,
Yes, sir.
same number?
Sir, I'm getting a very close
Or-
number of 110.63.
Okay, 110.63. So now we have, so basically these two numbers we are getting. So this problem is, not that much difficult. So 6 7th, 8th, 9th, and 10th. And then you have up to infinite. So in this region, if you read this problem says that this is the period of a supernormal growth rate of 8%. And this period is some kind of normal growth of 6%. And after that, you will have a growth of consistent or constant growth of 3%. And remember our valuation formula. When you have constant growth rate, div1 ke or r minus g. So this will be applicable here in this region, because you have up to infinite, you have constant growth. So whatever, so basically you need dividend for 11th here. So that once you plug this here, you will get value of all dividend at the end of 10th here. This is one part. And then of course, once you discount, all these values that you are getting here, if you discount it for appropriate 10 years time period, then you will have present value of dividend for third part of this model. In this case, either you use shortcut approach or you calculate and discount it 2, 3, 4, 5, and 6. So in this case, problem says that your last year payment, or you can assume this is D0 or DIB10 is which is your benchmark, was $5.50. It means in this case here, you expect a growth of 8%. So 5.50 into 1.08. And this will be 5.50, 1.08 square. And if you solve this, you will get, this will be your term 5.50, 1.08 power 6. And from here to here for this section, again, your growth rate is 6%. So this will be div6 into 1.06. So this is the way how you are going to decide dividend. You are expecting over a period of 6 plus 4 years. And then of course you are going to discount it. So I think here I think I made some mistake. That's why. So can you verify whether this number is correct? Anyone? Of course, this seems different number. So what we were expecting, this versus 110.36, I guess.
Sir, I am also getting
63.
111.45 now. After rechecking my calculation.
Yeah, because here I'm sure I have made some mistake. So and because of that, but approach wise, I think you can go ahead. So if I'm not wrong, the correct answer is this, because when I use,
So the individual numbers are okay, but this total sum.
So I have problem here in total sum, right?
Yes, sir.
Yeah, that's what I am also thinking, that somewhere I have made mistake, because this part is clear, this part and this part is clear, but when I'm taking the sum here, I have made mistake. So anyway, but in terms of calculation, your correct number is 111.45. So this number, because in somewhere when I was using and putting here, I made a mistake. But this is how you should be, approaching to this type of problem. So approach is like this. You need to split this problem into 3 problems, and for each, sub period, supernormal growth rate, normal growth rate, and constant growth rate. For these 3 regions, you will have to do this, and so you can use 2 type of approach. You can use annuity formula. Remember, annuity formula for both the region, this region and this region. So if you are using annuity formula, let's say for region 1. So in that case, you will have to adjust your growth rate, because if this is GP series, it will be 1.08 divided by 1.10, because your discount rate is 10% here. So in that way, you will be able to calculate. So only your R value will change. Otherwise, the way we have done previously, same way you will be able to do that. So this is one type of problem which is very normal case, and we do see in our regular life. Initially, if when company is doing well, company won't mind sharing with shareholder profit, whatever profit is earned. And then once company get into mature, mature where sales are not that much good because of various reasons, then dividend may come down. And then subsequently, when company thinks now this is what we can offer to our valued shareholder, so they may offer 3% or some kind of low dividend policy they can follow, and they can pay to their shareholder. But here, in whatever problem we have discussed, if you see, there is some kind of payment throughout the year. There is no year where there is no dividend payment. So that's why, as we have also discussed yesterday, that dividend discount model will be, can be used when you have basically constant dividend payment. And now here, what I have done to better understand, I have created this scenario. So what scenario I have created, so that you can know by looking this scenario when ideally company should go and make dividend payment, and when company should not. And this is very logical case as well. Why I'm saying logical, because if you remember, when we talk about return on equity, how we measure profit after tax divided by total equity contribution. Basically, this tells how much return has been generated or created by the company for their common shareholder. Because here in denominator you have equity part. So it means if a company is able to invest the taken amount means if company has made profit and from that profit company is retaining, in that case, if ROE value is higher than cost of capital, or capitalization rate, or KE, or R, various names you may find. So if that is the case, so based on that we can say that yes, company, because company is able to create more return for the shareholder, it is better to keep. But we need empirical evidence. Unless we see the number, we cannot go blank, go without looking all those number and take a decision. So here you see company having EPS, earning per share of rupee 10. So what is earning per share? EPS is basically, in accounting how we represent, this is profit after tax, net profit divided by number of outstanding shares. If company made 10 lakhs of profit and company issued 1 lakh of share, then EPS will be 10. So basically, this is representing the profit in terms of rupee per share. And this is cost of capital, K, that we have used, or here basically RS is nothing but cost of capital. So in this case, you see what we have done, we can convert, this is your DIV1 or D1. So from here, because we can represent this equation in terms of earnings, earning per share, or EPS is nothing but, dividend is nothing but how much proportion of earning is distributed. And B here is retention ratio. Retention ratio means how much proportion of profit company is retaining for reinvesting in certain project. So we can replace D1 by this, and if you rearrange, so your P by E ratio. So this is forward looking in, if you follow, finance news. So this is forward looking. Why? Because here, if you see, we are talking about 1 year down the line, expected earning per share or projected earning per share. So that's why we call it forward looking PP by E ratio. Because this is the, when we calculate this represent the current market price, and this is 1 year, hence your expected EPS. So this is what, formula, we get. Now coming back to this problem. So we have 3 scenarios, your earning per share is constant. You have 3 type of, scenario. In this case, if you see, this case suggests your ROE is less than K, ROE is equal to K, and here ROE is greater than K. So 3 scenario we have. Now here you see for each, so now what we are doing, if company having P as this retention ratio or payback ratio. So these are the values for companies. If company goes for assuming that constant growth model for a company, and we do that, what you will find if you estimate it. So you will find that here you see company 5%, then company is keeping 25%, 75%, and 95%. And if we calculate for all these 3 scenarios, what you will get that company having good profitable a high ROE, that company share price would be high. So basically here you will get a scenario for each 3 conditions, and here we will get, this is 4 by 3 kind of matrix. So if we calculate, what you will observe that in this case where ROE is equal to K, the price of share won't change, whatever this retention policy company follow. Whereas when company is following high retention policy, in this scenario, when a company can generate good return, even for reinvesting the profit, you will find value of firm would be low if company is retaining less. And here it is better for company to distribute more, because when you calculate price of share, here you will find it will be declining. So numbers you can see here. So when company is retaining 5, means company is basically distributing 95% of 10 rupee. So value of share is coming how much? 65.5 rupee. When, so this is the case of this, when ROE is less than K. And when company is, paying 95, then this is the value we are getting. And in this case, if you see value of stock throughout is same. It means in this scenario, it is irrespective of this retention policy, value of share won't change. So whether company management thinks to keep all the profit or distribute it, it is not going to add any value. Whereas in this case, scenario is opposite. In this case, it is suggested that company should retain, because when company is retaining, company is will have higher value. So this is how we can decide when company's value is going to change. And this is one more problem for you. So this problem, if you are able to do, your understanding of time value of money will be very clear. So I expect at least this is the last problem, and then we have 3 more slides to discuss. So but I would first we will discuss this problem and then go for subsequent slide. So I'll explain you this problem. So there is one person, Jenny. She is planning to buy apartment in Delhi. Considering the savings, she need additional 62 lakhs to buy an apartment. After a long bargaining with her bank, she has decided to take a fixed term loan from the bank, and bank has agreed to support her fund requirement 10% annually for 15 years. So what you have to do, you have to calculate EMI. EMI that she will have to pay if she takes this loan, 62 lakhs loan. And you have to also calculate interest component. If interest component that she will be paying as a part of EMI. Because if you are able to do this problem, your normal a daily basis problem, whatever you see, whenever you go for taking bank loan or some other type of loan, you will be able to understand that problem and take well-informed decision. So I expect you all to try this problem. If you have any question, you can ask related to this problem. If anywhere you are finding it, not clear. Yeah, can you all see my screen, this problem?
Yes, sir.
Sir.
Okay, yeah, so I'll give you clues so that so remember your EMI. EMI means you are going to make 12 payments in a year. So this is your 15 year. This is year 1. So I'm assuming that remaining scale represent remaining 14 years. So assuming that you will have 12 payments in this, so you will have one EMI here. Another EMI you will be paying here. Same way. It means you are taking loan at this point of time, because 62 lakhs loan you are taking, Jenny is taking here. And these are the EMIs. So what what these EMI means? The value of all these payment ideally should be equal to what loan you are taking here. So it means EMI is nothing but some kind of annuity. And here your payment is, your frequency is 12 times in a year, because this is EMI, monthly payment. So now I believe you should be able to get this problem. So EMI represent your annuity, and this annuity is paid every month to your bank for availing this 62 lakhs loan. So you are going to use annuity formula. And annuity formula, how basic formula I'm writing, so that when we say annuity, so present value of annuity would be amount 1 minus 1 plus r to the power n minus n divided by r. This is when you have annual payment. So you will have to make some adjustment, then you will get it. So basically this part is nothing but EMI. So I have already given you, almost all the clue. You should be able to solve this problem. At least CMI you should get immediately. So in this, we are purely using application of time value of money and interest rate. That's it. So we are not using valuation related concept. And better you use your Excel so that it becomes easy rather than using, if you use calcs, sometimes we make mistakes. Already we have discussed this time value of money concept, if you remember. So I'm further giving you, solution. So here, because you are paying interest at frequency of 12 times, so this will be divided by 12. This will be divided by 12, and this will be multiplied by 12. Now you have to just plug in all these numbers, and you should be able to get it. Can anybody tell what EMI you are getting?
So the present value of VMIs I am getting is 48 lakh.
48 lakhs? EMI,
Yes,
48 lakhs.
So there seems to be a calculation error. Just let me check.
You think, can somebody pay 48 lakhs per month for taking 62 lakhs loan. So some error is there. I think you will have to identify. That
Sir, I am
cannot be
getting
the case.
66,000.
Yeah, that is reasonable. Yeah. Other students, I'm also calculating because if yeah.
66,625. Yes, sir. And another one
Yes,
is
66,000.
63,805.
Right, and remember, I think 66,000 seems correct answer. So here, so what to know how much interest you are going to pay? Here you see second part of problem. So if EMI is how much you said 66,000.
625.
Can anybody tell? Repeat.
66,625.
120.
625.
Okay, this number. So now remember to know how much interest you are going to pay. So how many times you are going to pay this much amount? You are going to pay for 15 years and these many months, right? So if I multiply this, this will give you total payment. Payment by Jenny to the bank. So,
Sir?
and if I subtract 60, yeah.
So now I'm getting 6,665. So 66,000 is.
Okay, let me then calculate. If because I was assuming 66,000 seems, let me just compute. So I'm getting 66. I'll show you my screen. I'm getting so can you see my screen? Hello? Hello?
Yes, sir. But it is a bit blurred.
Okay, so I'm
like-
getting. Okay, I'll increase the font size. Now, can you see?
Yes, sir.
So, so this is R by N, and this is 1 plus R by N, and this is 1 plus R by N. So this is what, so I'm getting 66, I'm getting 66,625 rupee per month. So if I multiply this by 15, sorry, I multiply by number of years into number of payment every year. And if I subtract 62 lakhs from here, so around 58 lakhs you will be paying to your respective bank to avail this 62 lakhs of loan. Can you all see? So this much amount you will be paying as interest, and total amount you will be paying 1 crore 20 lakhs to avail this 62 lakhs of your loan. So I believe it. Is there any problem? Any question? If you have, we can discuss. Fine. So I believe you all are able to understand this, time value of money concept. And if you have any other question, we can further take it in next week. And as I said that next week, you all will have quiz. So I'll let you know mode. I'll check with the Moodle team if they can assist us. Otherwise, we will have on MS Team itself. Any question? If you have any question, we can quickly take it. Otherwise, we will close today's session. Fine. So it seems no further questions. So we are closing today's session. We will meet next week. Yeah. Thank you.